Welcome to Sales Tax and More, your go-to resource for all things state tax related. Now, here is your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales Tax and More, and today's co-host for the Sales Tax and More podcast, where we talk about everybody's favorite subject, which is, of course, sales tax. Today, my co-host Ellie Moffitt and I are going to be discussing why income tax is going to be the next big battle for e-commerce sellers. But before we get into that, I want to introduce you to Ellie.
Hey, everyone. This is an incredibly helpful podcast today. I'm excited for you to take a listen. I want to do a quick introduction for Sales Tax and More before we get started. Sales Tax and More is a full-service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registration, sales tax audits, consulting, research, and like our name states, more. So if you'd like to get in touch with us about any of our services, or if you have any questions, please reach out. There are plenty of ways to do so in today's show notes. So Mike, we have done a number of presentations about why income tax is going to be the next big battle for e-commerce sellers. I know we've talked about it at events and our own material. Can you share with our audience why?
Absolutely, Ellie. And it all has to do with Public Law 86-272. That's a federal law. A lot of people hear 86 and they think this was passed in 1986. It was not. That was the 86th session of Congress. It's actually was passed back in 1959. It's also known as the Interstate Income Act of 1959. And it was passed in direct response to a U.S. Supreme Court case called Northwestern Cement. In Northwestern Cement, the end results pretty much were that states could tax interstate commerce pretty much any way they wanted. And business got all upset and Congress got all upset. And within 7 months, they passed this Interstate Income Act of 1959. And what that basically said is that if your only activities in a state with a solicitation of tangible personal property, something that could be seen, could be felt, can be touched, something that's perceptible to the senses, as opposed to intangible property or services or digital property. So if you're only selling tangible personal property and all the orders are sent outside the state for approval, and then they're fulfilled from a point outside the state into the state, then that state was prohibited from imposing a net income tax on you. So an interesting side note, some of us believe that the Congress has been do nothing the last 4 years or the last 8 years or 12 years, or plug in a number there. On some topics, they've been do nothing for quite a while, because when they passed this federal law, they passed it very quickly. They passed it within 7 months, but they said that Nexus is so confusing, it's so complex that they got to form a bunch of committees and do a bunch of studies and commissions and, before they could come up with a permanent solution. Well, here we are 61 years later, soon to be 62 years later, and we still have this temporary, antiquated solution. Now, up until this point, if you had a pure economic nexus, it's protected you, but a lot of things going on that may change that. But let's switch gears a minute here and let's talk about Amazon sellers. Those who use the Fulfillment by Amazon program, we refer to them as the FBA sellers. So most of them do sell tangible personal property. Most of them, the orders are approved from a point outside the state. Here's the problem. In quite a number of states, they have inventory, and at least some of the orders are going to be fulfilled from a point inside the state. And according to the plain language of the law, that means you're not protected. It has to be fulfilled from a point outside the state. And it's all or nothing protection. So you don't say, well, this percentage of my sales is subject to the income tax because they were fulfilled from inside the state, and 75% was fulfilled from a point outside the state. So therefore, the tax isn't. No, it's all or nothing. So you either have the protections of Public Law 86-272 or you do not. So with FBA sellers, with all this inventory, spread out all amongst the country, whether they put it there themselves or not, the majority of states, just look at, are they being fulfilled from a point inside the state? And that third criteria, these FBA sellers just can't meet. So we've been saying that now that the states have forced the marketplaces to collect all this information, they've written into their statutes that, they can require information to make sure the taxes are being handled correctly. And once they, get their arms around all of this new sales tax, we've been saying, we think that FBA sellers, large FBA sellers, are going to be the next target of the states because they don't meet this criteria. And so the states are going to say, who are you bigger sellers? Who's doing the most business here? And Amazon's going to, and these other marketplaces, going to have to turn over the information, and the states are going to pursue them. So I predict that that's going to be happening sometime, I've been predicting sometime over the next year to two. However, California started us off early. They fired the first shot. And they look like they have gotten their hands on the information that came from Amazon. It was originally given to the California Department of Tax and Fee Administration. And it looks like they know who has inventory during 2017 in their state. And they consider inventory, whether it's consigned or otherwise, to be Nexus creating. And Nexus just means creating a link or connection with the state where you'd have to collect the sales tax or pay the income or franchise tax. So the first shot has been fired. California is going after franchise tax sellers. They sent out the first round of letters back in the end of September, beginning of November. I just found out that they sent out the second round. So it looks like they're going to be doing this in rounds. Those letters are a lot more aggressive than any of the letters that the California Department of Tax and Fee Administration sent out. It looks like they're going to be a lot more aggressive in their pursuance of these FBA sellers. So we think that California is just the first state. We think that more and more states are going to be pursuing FBA sellers because they're not protected by Public Law 86-272.
Okay, so Mike, it's already started with FBA sellers. What about e-commerce sellers?
Yeah, so there's a distinction. I think it starts with the FBA sellers, but a couple of things happening out there. With this Public Law 86-272, it only protects you from a net income tax. So there are states like Texas, their franchise tax is actually a gross receipts tax. A state like Washington, their business and occupation tax is a gross receipts tax. A state like Ohio, their commercial activities tax is a gross receipts tax. The Nevada tax is a type of gross receipts tax. So all of these taxes, you're not protected by Public Law 86-272 because they're not net income taxes. We also have a state like Kentucky with their limited liability entity tax. It's not a gross receipts tax. So one of the things we may see is more states come up with these gross receipts taxes. The state of Oregon, they want a piece of this, remote revenue. They don't have a sales tax. They don't want to pass a sales tax. They do have an income tax, but hey, this public law says that income tax doesn't apply. So they went out and they created a gross receipts tax. It's the commercial activities tax of Oregon. So we've got two cats out there, one in Ohio, one in Oregon. So the at $750,000, once you cross that threshold, you're required to register in the state of Oregon, but you don't have to actually, file a return till you pass $1 million. So this is one of the ways around Public Law 86-272. And I think that we're going to see a lot more of that. And, not only do we have to worry about the states, but we got to worry about some of these cities like Philadelphia. Up until recently, Philadelphia said, if you have a physical presence in the city, then you're subject to their gross receipts tax, whatever they're calling it nowadays. They recently came out within the last 3 or 4 months or so and said, okay, we are moving to an economic nexus. And they actually moved to an economic nexus before the state of Pennsylvania did. So not only do we have to worry about these states, but we also have to worry about the cities. If you're over $100,000 of sales into the city of Philadelphia, then you're subject to that municipal tax in Philadelphia. There are other cities like that we have to worry about. Some of them are currently physical presence, but we may start seeing them switch over to this economic nexus, just like Philadelphia did. So we got to worry about states and cities.
So, Mike, I've heard you say that PL 86272 is under threat as well. Can you talk more about that?
Yeah, absolutely. Not only are the states trying to go around Public Law 86272, a state like Massachusetts is trying to go right through it. They're looking at the Wayfair case, and they're interpreting that, and then they're saying, well, based in light of how Wayfair was decided, we think Public Law 86272 is unconstitutional. So they're looking for a case that they can try to bring to the U.S. Supreme Court to get this Public Law 86272 declared unconstitutional. Now, that's going to take a few years. But, it's I can see the state's point. So that's something that we have to worry about. But much sooner than that, we've got to worry about the Multi-State Tax Commission. The Multi-State Tax Commission is a quasi-governmental agency. They provide guidance to the states. One of the areas they provide guidance is how states should interpret the protections of Public Law 86272. They have guidance on 13 protected activities and 20 unprotected activities. And up until this point, the unprotected activities, you had to, like collection services, pretty much they had to be getting done in state. So because, the world viewed nexus as being a physical nexus, and this goes back to 1959, you got to remember, they look at these activities as being in state, and they weren't really thinking of them in today's terms until we have Wayfair. And now if, an economic presence is enough for sales tax, why is that not the same for the income tax? That's what they're saying. So they've come up with a new set of guidelines, and they put them out for comment. They haven't fully implemented them yet. But what these new guidelines are, if you offer after the sale, if you're offering customer service through a chat or through email, or if your website uses cookies, they consider this to be a in-state presence. So you basically have nullified the protections of Public Law 86272. Now, we're still can go into the old guidelines because these haven't been fully implemented, but I expect them to be implemented at some point in the next 6 months or so, if not sooner. So we've got to make decisions, unless Congress steps in and says, oh no, we want income tax to be physical presence. Economic nexus is okay for sales tax, but for income tax, we want a physical presence, which I don't see that happening. You got to remember, it's been 61 years since Congress weighed in on this very issue. I don't see, with how divided they are today, of them getting anything done anytime soon. So I think we're going to have to deal with what the MTC is saying, and there will be lawsuits. But I think that while we're waiting for these lawsuits to be settled, or I think that the states are going to be coming hard after e-commerce companies. So it's not just Amazon sellers that the states are going after. The next 6 to 24 months, I think we're going to see income tax become a huge battle for all e-commerce sellers.
Okay, so Mike, circle us back to the bottom line here. What is the bottom line?
Bottom line is we've got to make sure that income tax is part of our conversation. If we're accountants, then we need to be talking to our clients about perhaps filing in more states. If we're actually sellers, then we need to realize our compliance requirements may be higher. It costs money to file more returns. This is going to be a lot bigger issue for larger sellers. I mean, if you're a $200,000 or $300,000 seller, you could still have exposure for sales tax that's material in some states. Because, sales tax is done on gross sales, where income tax is usually done on your net sales or your profits, really. So, you could be $1 million seller with 10% profits. That $1 million, could have, a lot of exposure. The $100,000 is going to have a lot less material exposure there because that's going to be spread out over multiple states. So I still think we need to look at materiality. Just because a state says you should do something doesn't necessarily mean it makes good business sense to do so. We have a client that their bookkeeper has gotten them registered everywhere, every city, every county, every state for income taxes, all types of business taxes. And I said, whoa, slow down. You're getting a little bit carried away here. We're big believers that where your exposure is material, then this is something we got to look at going forward. However, if the cost of compliance, in other words, if you're going to pay someone more to file a return, then you're going to actually pay the state if they ever come after you. Why in the world would you go ahead and do that? To me, I think we need to use common sense. And again, just because the state says you should do it doesn't make it's good business sense. Sometimes it makes better sense to let the state or the local jurisdiction come after you. So although this is going to be a much bigger issue for larger sellers, even some of our largest sellers, your 100 million, 200 million, 500 million, they don't always file everywhere. They pick and choose those jurisdictions where they have the greatest exposure. And I think that that's good advice to follow. We need to be doing the same thing. We need to be using the common sense. And where appropriate, we need to start getting registered and paying the income tax. Now, a lot of people hear this and they're saying, well, if I pay income tax in every state, I'll be broke. If you're paying income tax in another state, you're generally not paying it on that sales that are apportioned to another state. So, there might be some minor discrepancies. The big issue here is the compliance. Now you have to file a bunch of returns, but because you're getting credit on these sales that are being apportioned to other states, the overall amount of tax is not going to change much unless your home state is one of the states that doesn't have an income tax. So, if you're in Florida, you're in an LLC, yeah, all of a sudden your tax burden may be going up. But if you're, a C Corp in New York, there's, in theory, your taxes could actually be going down. So there'll be lots of opportunity for tax planning when it comes to state income taxes here.
All right. Thank you so much, Mike, for all this great information here. I do want to put out there for everyone that if you have sales tax needs, we do offer many solutions and services. You can reach out to me directly if you have questions or if you'd like to work with us. My email is emoffat, EMOFFAT @salestaxandmore.com, or visit our website, salestaxandmore.com. In addition to our services, we offer an entire series of free webinars. We have these podcasts, we have video snippets, a ton of free resources for you, as well as paid research sources as well. So thank you, everyone.
And as always, I want to thank everyone for joining us for today's episode of the Sales Tax and More podcast. And we hope to see you on the next episode. Thanks. Bye-bye.
Thanks for listening. Be sure to click subscribe and check out all of the resources we have out on the web.